Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Why Risk Parity Investing Matters, a beginner's guide. Market conditions and risk misestimation. Risk parity relies heavily on accurate risk estimates to allocate investments effectively. But what happens when market conditions change suddenly? This strategy can become vulnerable. Market shifts can lead to misestimations of risk, meaning the calculated risk levels for different assets might no longer align with reality. These miscalculations can result in improper asset allocation, leaving portfolios exposed to unexpected swings. Moreover, in times of financial turmoil or when unexpected economic events occur, historical data and volatility models may fall short. They don't always predict how assets will behave under new or extreme conditions. This is like trying to predict the weather using last month's forecasts. Sometimes, the skies have other plans. Investors must remain vigilant, frequently reassessing and adjusting their portfolios to align with real-time market behavior. Failing to do so could compromise the effectiveness of the risk parity approach, leading to potential losses or increased volatility. Complexity and implementation costs. Risk parity is not your average investing strategy. It comes with its own set of complexities that can deter some investors. Implementing a risk parity strategy requires deep knowledge of financial markets and a robust understanding of statistical models. This isn't the kind of strategy you can set and forget. Moreover, the costs associated with risk parity can be significant. Here are a few cost-related challenges. Technology and analytics. Sophisticated analytical tools are essential to accurately assess risk contributions and rebalance portfolios accordingly. This technology isn't cheap, and neither is the expertise needed to use it. Transaction fees. Frequent adjustments to maintain risk balance can lead to higher transaction fees. These fees can eat into profits, especially for smaller portfolios. Management costs. Actively managing a risk parity portfolio often means higher management fees. This can deter investors looking for cost-effective strategies. Think of managing a risk parity strategy like running a high-performance sports car. It's exhilarating and potentially rewarding but demands constant maintenance, fine-tuning, and a bigger budget than your standard vehicle. Navigating these challenges requires a commitment to continual learning and adaptation. For those ready to embrace the intricacies, risk parity can still play a valuable role in a diversified investment strategy. Implementing a risk parity strategy. Implementing a risk parity strategy can transform how you approach investing. It's all about spreading out risks so no single asset class can unbalance your portfolio. But how do you get started? There are some core considerations and tools that can guide you on this journey. Key considerations for investors. Before diving headfirst into a risk parity approach, there are crucial factors to keep in mind. Understanding risk levels. Evaluate how much risk you're comfortable with. Risk parity isn't about playing it safe, it's about balancing risk across various investments. Know your risk tolerance to align your strategy with your financial goals. Asset selection. Choose a mix of asset classes that complement each other. A well-thought-out selection includes equities for growth, bonds for stability, and commodities for diversification. Think of it as creating a balanced meal for your portfolio, where each asset plays a different role. Regular rebalancing. Markets shift, and so should your portfolio. Regularly check your risk allocations to ensure they reflect current market conditions. This helps maintain balance and keeps you on track, much like a sailor adjusting the sails to keep the ship steady. Cost implications. Be mindful of the costs associated with frequent trading and management fees. High costs can eat into profits, particularly for smaller portfolios. It's like buying fine wine. You must factor in the price to appreciate its full value. These considerations can serve as a strong foundation for implementing a risk parity strategy that aligns with your investment vision. Tools and resources for risk parity investing. To successfully implement risk parity, you'll want to arm yourself with the right tools and resources. Portfolio management software. Use platforms like Morningstar Direct or BlackRock's Aladdin. These tools offer comprehensive analyses, helping you assess risk and make informed decisions. It's like having a financial compass that guides your investment journey. Risk assessment tools. Services like risk metrics allow you to evaluate potential volatility in your portfolio. Understanding these metrics will enable you to manage risk like a master conductor, ensuring harmony in an orchestra. Educational literature. Books such as Asset Management, A Systematic Approach to Factor Investing by Andrew Ng provide valuable insights into risk parity principles. Literature can be your library of wisdom, offering lessons from seasoned experts. Consultation with financial advisors. Sometimes, having a guide is imperative. Financial advisors can offer tailored advice to fit your specific needs and goals, acting as your investment mentor during complex decisions. Having the right tools at your disposal simplifies the process, enabling you to implement and maintain a robust risk parity strategy effectively. With these resources, you can confidently navigate the intricacies of risk parity investing. Future of risk parity investing. As markets twist and turn, so too must the strategies that investors use to guard their wealth. Risk parity investing, with its focus on balancing risk, finds itself at the heart of these shifts. As we look to the future, it's crucial to understand how this strategy will adapt and evolve to meet changing demands. Adapting to market changes. In the ever-shifting economic environment, flexibility is key. Risk parity strategies are no exception. How do they stay relevant? By evolving alongside the market. When inflation hits or central banks adjust interest rates, portfolios that depend heavily on one asset type might flounder. Risk parity plans, however, keep a balanced risk spread across assets, making them more adaptable in turbulent times. Think of it like a tightrope walker keeping their balance no matter how the rope sways. Investors using risk parity may also need to change their asset mix to reflect economic trends. If emerging markets grow, they might bring these into their portfolios sooner. Are commodities becoming more volatile? It might mean adjusting their weight in the portfolio to preserve overall balance. This ability to adjust and respond ensures risk parity remains a viable strategy even as economic landscapes undergo transformation. Innovations in risk parity models. The future will likely usher in new models and tools for risk parity. Advancements in technology and data analytics pave the way for more precise investment strategies. How might these shape risk parity approaches? Enhanced data analytics. Using big data and machine learning, investors can predict market behaviors with greater accuracy. This means more informed decisions and finer-tuned risk management. Automated rebalancing. With automation, portfolios can adapt instantly to market changes without human intervention. This reduces lag time and makes maintaining a balanced portfolio less labor-intensive. Diversification into new assets. Innovative models may incorporate newer asset classes like cryptocurrencies, providing additional layers of risk and potential reward. This could diversify risk even further. As these innovations develop, risk parity models will likely become even more sophisticated, offering investors a sharper tool for managing their portfolios in an uncertain market. Risk parity continues to be a dynamic strategy, adjusting to keep pace with market changes and leveraging technological advances. For investors, it offers a blueprint for stability and growth in a world where change is the only constant. Conclusion. Risk parity investing stands out in today's fast-paced markets by emphasizing balanced risk rather than just chasing returns. It's a smart way to manage your portfolio, especially when markets are unpredictable. This method spreads risk evenly across various asset types, offering stability and peace of mind. If you're considering risk parity, start by evaluating your portfolio's current risk balance. Think beyond profits and focus on how risk is shared. This approach could bring more consistency to your investment returns, even when things get rough. Wondering how this strategy fits into your financial plan? Dive deeper. Explore its potential benefits and challenges. Consider reaching out to a financial expert to discuss how risk parity might align with your goals. Making informed choices today could lead to more secure investments tomorrow. Interested in staying ahead in the ever-changing investment scene? Keep an eye out for future updates on risk parity. Your comments and questions are always welcome. We appreciate your time and interest. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.